Hey everyone, and welcome. Today, we're going to talk about a financial tool that you might not have heard much about, but it can be a real game changer for your retirement. It's called a non-qualified annuity, and my goal today is to make it super simple to understand.
So, let's imagine this. You've been doing everything right. You're saving diligently, you've hit the annual contribution limit for your 401k, you've maxed out your IRA. That's fantastic. But it brings up a really important question. What do you do next? Where can you put your other savings to keep them growing for retirement? Well, this is the exact problem a non-qualified annuity is designed to solve.
So here's our game plan. We're going to break this down into 5 easy parts. We'll start with what a non-qualified annuity actually is, then how it works. After that, we'll get into the pros and the cons, the really important stuff about taxes and penalties, and finally, where you can get some expert help. Sound good? Let's dive in.
All right, first up, what in the world is a non-qualified annuity? Let's get to the core of it.
Okay, in the simplest terms, it's a special type of savings account you set up with an insurance company. The key here is that you fund it with after-tax dollars. That's money from your paycheck that you've already paid income tax on. And here's the magic part. Once that money is in there, it gets to grow tax-deferred. That just means you don't pay any taxes on the interest or gains year after year. It all just compounds, and you only pay taxes on the growth way down the road when you take it out.
And this slide right here, this is probably the most important difference to understand. Your 401k or traditional IRA, that's pre-tax money. You get a tax break now, but when you retire and pull money out, every single dollar is taxable. A non-qualified annuity is the opposite. You use after-tax money, so there's no tax break today. But the huge advantage is that when you withdraw, you only pay taxes on the earnings. Your original investment, your principal, comes back to you completely tax-free.
Okay, so we've got the basic idea down. Now let's look at the nuts and bolts. How do you actually put money into one of these? And what are the different flavors they come in?
The good news is you've got a ton of flexibility. You can use money from a savings account, move funds from a brokerage account, or even use the cash from selling an asset like a piece of property. You'll also see something called a 1035 exchange, which is just a fancy, tax-free way to roll money from an old annuity or a life insurance policy into a new one. The one thing to remember is you can't use pre-tax money from, say, your 401k. This is strictly for your after-tax savings.
And just like cars, annuities come in different models. You've got your fixed annuities, which are super safe and give you a guaranteed interest rate. Then there are fixed indexed annuities, which are really popular. They give you the chance to earn more when the market, like the S&P 500, does well, but they also protect your principal if the market goes down. And then you have variable annuities, which are invested directly in the market and have more risk. For our purposes, we'll mostly focus on the fixed types since they're great for that balance of safety and growth.
You know, every financial tool has its good sides and its trade-offs. A non-qualified annuity is no different. So let's take a really honest look at both sides of the coin. The pros are pretty powerful. That tax-deferred growth is a big one, letting your money work harder for you. But for a lot of people, the absolute best part is that there are no contribution limits. You can put in as much as you want, which is huge if you're a high earner. Plus, no RMDs means the IRS won't force you to take money out. On the flip side, the earnings are taxed as regular income, not the lower capital gains rate. And, just like your IRA, there's that 10% penalty if you take out the earnings before you're 59 and a half.
All right, let's zoom in on what is, without a doubt, the most important part to get right, the taxes. How the IRS looks at withdrawals from these annuities is, well, it's unique, and you absolutely have to know how it works.
So, non-qualified annuities operate under a rule called LIFO. That stands for last in, first out. And what that really means for you is simple. The IRS assumes that the last money that went into your account, all those earnings and all that interest, is the first money to come out when you make a withdrawal.
Let's make this real with an example. Say you put $100,000 into an annuity, and over time it grows to $120,000. So you've got $20,000 in gains. Now, let's say you decide to withdraw that $20,000. Because of the LIFO rule, the IRS says that entire $20,000 is your taxable earnings. You don't get to touch your tax-free principal until all the gains have been taken out first. And, to add one more layer, on top of the regular income tax you'll pay on those gains, if you take them out before you're 59 and a half, the IRS will typically hit you with an additional 10% penalty. It's their way of making sure you use these for long-term retirement savings. Now that penalty rule isn't written in stone. The IRS does build in some really important exceptions for major life events, so you can often avoid that 10% hit in situations like death, becoming totally disabled,
or if you turn the annuity into a stream of guaranteed lifetime income. And this chart does a great job of pulling it all together. You can see the key differences right here, side by side. Pre-tax versus after-tax. Contribution limits versus no limits. Required distributions versus no requirements. And of course the big one, how withdrawals are taxed. It's a perfect little cheat sheet for seeing how these two tools fit differently into your overall financial plan.
So, as you've probably figured out by now, non-qualified annuities can be an incredibly powerful savings tool, but they're not exactly simple. The rules around them, especially with taxes, mean that having a good strategy is everything. This is not something you want to just set and forget.
And that's really where talking to a professional can make a huge difference. An expert can help you sort through all the options, find the best products out there, and most importantly, help you set it up in a way that maximizes your tax benefits and helps you steer clear of those penalties and fees. It's all about making the tool fit your personal goals perfectly.
If anything we've talked about today sounds like it might be a good fit for your retirement plan, our team here at the Annuity Expert would be glad to help you figure it out. We can walk you through your specific situation, answer your questions, and see what makes sense for you. Our consultations and our services are always completely free. Give us a call at 770-755-1565, or you can find more information on our website at annuityexpertadvice.com. Thanks so much for watching.